Central banks are some of the most powerful institutions in the world, and most people were never taught to question them. They don't make headlines very often. They rarely face elections. And ask 10 people what a central bank actually does, and most won't really know. Yet central banks control the price of your money, the direction of your economy, and the value of everything you work for. They can create wealth out of thin air, or erase it almost overnight. And the strangest part? They don't really answer to you. This is the story of how central banks came to dominate modern finance, not as neutral referees, but as active players in a game they helped invent. It's a story about hidden power, financial engineering, and the illusion of stability. And once you understand how it all started, you'll never look at your paycheck, your debt, or your savings the same way again. Let's go back to 1694. England was broke. The crown had just fought an expensive war against France, and the treasury was empty. What emerged wasn't a bank designed to serve ordinary people. It wasn't there to protect savings or support growth. It existed to fund the government and to profit from doing it. That's the real origin of the modern central bank. Not as a stabilizer, but as a lender to the state. And over time, that power only grew. By the 19th century, central banks across Europe followed similar models. Privately owned institutions with special privileges. They issued currency. They controlled reserves. They stepped in during crises. And in exchange, they gained enormous influence, often without real democratic oversight. In the United States, the story was messier. Americans were deeply suspicious of centralized financial power. The first and second banks of the United States were both shut down after fierce political battles over corruption and elitism. For much of the 19th century, the U.S. had no central bank at all. The result was chaos, private currencies, speculative bubbles, and violent financial panics. Then came 1907, a panic so severe that one man, J.P. Morgan, had to personally coordinate a rescue to stop the system from collapsing. That moment changed everything. In 1913, Congress passed the Federal Reserve Act, creating the Federal Reserve System. It was sold as a decentralized network of regional banks, meant to stabilize the economy. In reality, it became a central authority with immense control over interest rates, credit, and money supply. And here's where things get uncomfortable. The Federal Reserve isn't a traditional government agency. It's an independent institution with both public and private elements. Its board is appointed by the president. Its member banks are privately owned. It's funded not by taxes, but by interest on government debt and fees charged to banks. It makes decisions that affect millions of lives without any direct voter input. So who does it really serve? Officially, the Fed has a dual mandate: maximum employment and stable prices. Unofficially, its actions often benefit the very institutions it's supposed to regulate. In 2008, the Fed didn't just lower interest rates, it printed trillions of dollars. It bailed out investment banks. It propped up asset prices. It guaranteed toxic debt. In 2020, it did it again. It bought corporate bonds, flooded markets with liquidity, inflated asset prices. Stocks soared, real estate exploded. Those who owned assets got richer. Everyone else was told to wait. This is the deeper truth most people never hear. Central banks don't just influence the economy, they shape it. They decide who wins and who loses. When rates are cut, stocks rise. When rates are raised, markets fall. When money is printed, asset holders benefit. When rates go up, ordinary people pay more for mortgages, credit cards, and car loans. And while central banks claim independence, they are deeply entangled with the financial system they oversee. Their leaders rotate in and out of investment banks. Their language is deliberately technical. Their decisions are wrapped in jargon that keeps the public at a distance. Today, central banks are more powerful than ever and less accountable than ever. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England. These are not neutral institutions. They are the architects of our monetary reality. Since 2008, they've transformed the global economy. Low interest rates became permanent. Quantitative easing went from unthinkable to routine. Trillions were created to buy government bonds, corporate debt, and mortgage-backed securities. Asset prices soared for those who owned assets. It was a golden age. For everyone else, it was inflation disguised as prosperity. Housing became unaffordable. Wages lagged behind prices. Savings earned nothing. Most people blamed politicians, bad luck, or the economy in general, not the invisible hand controlling the money supply. Here's the hard truth. The modern financial system isn't designed to set you free. It's designed to keep you moving. Central banks reward debt. They punish saving. They grease the wheels of consumption. Every intervention is framed as stability. But it's not your stability they're protecting. When things break, central banks step in to save the system, not the people. Look at 2020. Markets collapsed faster than ever before. Within weeks, trillions were injected. Stocks recovered. Billionaires doubled their wealth. Millions lost their jobs. Small businesses disappeared. Renters faced eviction. What was saved wasn't the economy. It was the appearance of strength. Debt grew. Balance sheets expanded. And dependency deepened. This matters because when central banks distort the price of money, they distort everything. Risk becomes harder to price. Saving becomes harder. Retirement feels further away. They create bubbles, then crashes, then rescue the system again. And most people never realize what's happening. They don't see that their student loan rate, their savings return, the price of their home, all flow from decisions made in rooms they'll never enter, by people they'll never vote for. So who controls central banks? Officially, they're independent. In practice, they serve the system that created them. The banks, the markets, the financial elite. The revolving door between Wall Street and central banking isn't a conspiracy. It's a career path. And the language of central banking exists for one reason: to keep outsiders out. But you're not an outsider anymore. Because once you understand how the system works, you can stop playing it blindly. Financial education isn't just about investing or budgeting. It's about power. It's about understanding that money isn't neutral. Inflation isn't random. Interest rates are political. Freedom starts with understanding the system and stepping outside its traps. That might mean owning things that can't be printed. Building income not tied to debt cycles. Questioning the idea that prosperity must come from endless growth. Because growth powered by debt is a treadmill. And the faster it spins, the harder it is to stop. So what can you do? Start by seeing clearly. Central banks are not gods. They're players. Their tools aren't designed for your freedom. They're designed to stabilize markets, protect institutions, and preserve a fragile, debt-driven system. You can't fight that system directly, but you can position yourself outside its reach. Diversify, simplify, reduce dependence on debt, own things that matter, learn how money really works, and teach others. Because when the next crisis comes, and it will, central banks will do what they always do. They'll protect the system. It's up to you to protect yourself. History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.